Let's break down one of the lesser-known but high-yielding dividend plays in the real estate sector. Ready Capital Corporation, ticker symbol RC. This is a real estate finance company that often flies under the radar, but it has a unique business model that separates it from traditional mortgage REITs. If you've been hunting for high income, especially monthly or quarterly dividends, then RC might already be on your watch list. But before you dive in, let's take a deeper look. Ready Capital Corporation specializes in originating, acquiring, financing, and servicing small to medium balance commercial loans. It is structured as a mortgage real estate investment trust, also known as a mortgage REIT or MREIT for short. Unlike equity REITs that own and manage properties, mortgage REITs like RC primarily deal with real estate debt. In this case, RC focuses heavily on commercial real estate-backed loans, bridge financing, and government-guaranteed loans through programs like SBA Section 7A and 504. RC's bread and butter is short-term bridge loans used to finance transitional or underperforming properties. These are usually commercial properties that need renovation or repositioning before securing permanent financing. This gives Ready Capital a higher yield opportunity, but it also introduces risk if those projects stall or the borrowers default. Now here's where it gets interesting. Unlike traditional mortgage REITs that lean heavily into agency-backed residential mortgage-backed securities, RC is highly concentrated in small balance commercial real estate. It focuses on multifamily, office, mixed use, and even industrial property types, making it a bit more diversified in loan exposure compared to pure play residential mortgage REITs. So let's talk dividends because that's where RC gets attention. As of 2025, Ready Capital pays a high quarterly dividend that translates to an annual yield often north of 13%. It has maintained a relatively steady payout, though it has gone through cuts in the past during times of economic stress, such as the pandemic or commercial real estate slowdowns. Still, RC continues to be one of the top-yielding mortgage REITs on the market, attracting income-focused investors. But with high yield comes high risk. The biggest concern with RC lies in the commercial real estate sector itself. With rising interest rates, refinancing has become more expensive and property values have compressed. Office space, in particular, continues to face high vacancy rates, which may hit RC's loan book. The firm has increased its loan loss provisions in recent quarters, acknowledging some potential headwinds. It also operates with significant leverage. This is typical for mortgage REITs, but it amplifies both returns and risks. As of the most recent data, Ready Capital carries a leverage ratio of about 3-to-1, which is moderate compared to its peers, but still worth monitoring closely. Another layer to watch is the dividend coverage. RC's core earnings do usually cover its dividend, but barely. If core earnings slip due to rising defaults or lower originations, the dividend could come under pressure. Historically, RC has made small cuts and increases to its dividend as market conditions shift. So this isn't a buy-and-forget income stock. You'll want to monitor it quarterly. One positive worth noting is their merger activity. In early 2023, RC completed a merger with Broadmark Realty Capital, another commercial mortgage REIT. This added to their loan portfolio, increased scale, and provided cost synergies. Mergers like this can improve long-term efficiency, but they also take time to realize full benefits and bring new risks from the absorbed portfolio. From a valuation standpoint, RC typically trades at a discount to its book value. As of now, it trades at a price-to-book ratio under 1.0, making it look cheap on paper. But remember, with mortgage REITs, the book value can fluctuate based on interest rate shifts and the health of the underlying loans. So while the discount may be appealing, it reflects investor caution. If you're comparing RC to other MREITs like AGNC or NLY, you'll notice RC's higher exposure to commercial rather than residential mortgages and slightly more complex loan structures. RC does not have agency backing on most of its loans, so there's no implicit government guarantee. That means more risk, but potentially more reward. So is RC a buy? If you're seeking high income, have a strong stomach for volatility, and are willing to actively monitor your holdings, then RC might make sense in a diversified income portfolio. But if you want to set it and forget it dividend play, RC might be too volatile. It is not margin call proof. It is not recession proof, but it is an aggressive yield generator for those who want to take a swing at risk for reward real estate income. My meter rating: income potential, 8 out of 10. Risk level, 7 out of 10. Sustainability, 6 out of 10. Growth potential, 5 out of 10. Total score, 6.5 out of 10.